Banks are now legally allowed to freeze your account if you're over 65, and most people don't find out about this rule until it happens to them or to someone they love. I'm Margaret Wells, and on this channel, I dig into the rules, programs, and fine print that affect people in retirement, the stuff that almost never gets explained in plain language anywhere else. If you're new here, consider subscribing because I cover one of these hidden rules every single week. And this one is something every senior and every adult child of a senior needs to understand before it ever shows up in their own bank statement. So let's get into exactly what this rule is, why it exists, and what it actually means for your money. Here's the first thing to clear up, because the headline sounds alarming and it should grab your attention. But the reality is more specific than banks can just freeze your account because you turned 65. That's not quite how it works. What's actually true is that banks and credit unions across the country now have explicit legal permission, and in many cases, legal protection, to delay or temporarily hold transactions on an account when they suspect financial exploitation of an older or vulnerable adult. This isn't some obscure internal bank policy. It's built into federal law through something called the Senior Safe Act, and it's reinforced by a financial industry rule called FINRA Rule 2165, plus a patchwork of state laws that often use 65 as the age marker for who counts as a senior or vulnerable adult for these purposes. So the headline is true in spirit. Banks really can hold your money without your permission, but it only happens under specific circumstances, and understanding those circumstances is what protects you. Let's start with where this rule actually comes from, because that context matters. Back in 2018, Congress passed the Senior Safe Act as part of a larger piece of banking legislation. Before that law existed, bank employees were in a strange position. If a teller noticed that an 80-year-old customer was suddenly withdrawing thousands of dollars in cash every week or wiring large sums to someone they'd never mentioned before, that employee often wanted to say something, wanted to flag it, but worried about violating privacy laws or getting sued for overstepping. The Senior Safe Act changed that by giving bank and credit union employees legal immunity when they report suspected financial exploitation of an older adult to the right authorities, as long as they've had proper training. That single change unlocked a lot of action that simply wasn't happening before, because employees no longer had to choose between protecting a customer and protecting their own job. Around the same time, the financial industry's own regulatory body, FINRA, which oversees brokerage firms and investment accounts, rolled out Rule 2165. This rule does something very specific. It allows a firm to place a temporary hold on a disbursement of funds, not the whole account necessarily, but a withdrawal or transfer, if the firm reasonably believes financial exploitation is happening to a client who is 65 or older, or who has a mental or physical impairment that makes it harder for them to protect their own financial interests. That phrase, reasonably believes, is doing a lot of work in that sentence, and we'll come back to what triggers that belief in a few minutes, because that's the part most people actually want to know. Now, here's where it gets even more layered, because federal rules are only part of the picture. Most states have also passed their own versions of these hold laws, sometimes called vulnerable adult financial exploitation statutes, and they don't all work identically. Some states allow an initial hold of 15 business days, others allow 10, and many allow extensions if adult protective services or law enforcement gets involved and needs more time to investigate. Some states set the age threshold at 65. Others use a broader definition of vulnerable adult that could include someone younger if they have a qualifying impairment. This is exactly why I can't sit here and give you one universal number or one universal timeline that applies to everyone watching this video, because your state's specific law is going to shape exactly how this plays out for you. And I'd rather tell you that honestly upfront than pretend there's a single nationwide rule book. Picture two retired neighbors, both 71 years old, living on the same street but in different states. One of them has a credit union that, under their state's law, can hold a disbursement for up to 25 business days while investigating a suspicious wire transfer. The other neighbor's bank, in a state with a shorter statute, can only hold things for 10 days before they either have to release the funds or get a court order to extend the freeze. Same exact scenario, same age, same type of suspicious activity, but a meaningfully different experience depending entirely on geography. That's the kind of detail that almost never makes it into the alarming headlines you see about this topic, and it's exactly why I wanted to slow down and walk through it properly with you today. So, what actually triggers one of these holds? This is the part people are usually most curious about because nobody wants their account frozen out of nowhere over something completely innocent. Banks are trained to look for patterns, not single transactions in isolation. A few withdrawals at once usually won't trigger anything, but a sudden, dramatic change in someone's typical financial behavior tends to raise flags. That might look like a customer who has banked the same way for 15 years, suddenly authorizing large wire transfers to an account they've never sent money to before. It might look like someone showing up with a new friend or caregiver who insists on doing all the talking and answering questions on the account holder's behalf. It might be a string of gift card purchases in unusually large dollar amounts, which, if you followed any of the scam prevention coverage out there, you probably know is one of the most common red flags tied to phone and online scams targeting older adults. It can also include repeated large cash withdrawals that don't match someone's normal spending pattern, or a new person suddenly being added to an account, or power of attorney paperwork that seems to have appeared out of nowhere. Tellers and bank staff are increasingly trained to notice these patterns and to ask gentle, non confrontational questions when something feels off. Things like, "What's this transfer for?" or "Have you spoken with a family member about this?" If the answers feel rehearsed, evasive, or if the customer seems confused, pressured, or unable to explain a transaction in their own words, that's often what prompts an internal review. From there, depending on the bank's policy and the state law that applies, they may place a temporary hold on the specific transaction in question while they loop in their compliance team. And in many cases, they're required or encouraged to report the situation to Adult Protective Services, and sometimes to a previously designated trusted contact on the account. That trusted contact piece is genuinely one of the most useful tools tied to this whole system. And it's something I want every person watching this to actually go set up if you haven't already, because it puts you in control of the process instead of leaving it entirely up to a bank's internal judgment call. Most banks and brokerage firms now let you designate a trusted contact person on your account, someone the institution is allowed to reach out to if they notice unusual activity or have trouble reaching you. This person doesn't get access to your account. They can't move your money or see your balance just because they're listed. They simply become a point of contact the bank can call to check in. If you haven't named one, take a moment after this video to call your bank and ask how to add a trusted contact, because it's typically a free 5-minute phone call, and it gives the bank somewhere productive to go instead of just freezing things and leaving you confused about why. Now let's talk about what it actually looks like if you or a parent or a spouse ends up on the receiving end of one of these holds, because the uncertainty is usually the scariest part. If a hold gets placed, the law generally requires the bank to notify the account holder and, in many states, any other authorized party in writing, typically within 2 business days, explaining that a hold has been placed and at least a general reason why. This isn't supposed to be a silent freeze where your card just stops working and nobody tells you anything, although in practice, people sometimes report that the notification felt buried in fine print or arrived later than they expected, which is a fair criticism of how this is implemented in the real world. If this happens to you, the first move is simple. Call the bank directly, not through a number someone else gave you, but the number on the back of your card or on a recent statement, and ask specifically what account or transaction has a hold on it and why. From there, you'll usually need to verify your identity and may be asked to explain the transaction in question. If it really was a legitimate transfer, say you were sending money to a grandchild for a down payment or paying a contractor for a home repair, providing documentation or simply confirming the purpose in a phone call is often enough to get the hold released well within the maximum window the law allows. If the bank's compliance team isn't satisfied, or if Adult Protective Services has gotten involved because something genuinely looked like exploitation, the process can take longer, and in some cases, a state may need a court order to extend a hold beyond its initial limit. It's frustrating in the moment, I won't pretend otherwise, but it exists because, unfortunately, financial exploitation of older adults is a real and growing problem, with billions of dollars reported lost every year according to federal regulators. And a short delay on a transaction is a much smaller cost than someone losing their life savings to a scam that nobody caught in time. Let me walk you through a realistic composite scenario, not a real person, just a pattern I want you to recognize because it's the kind of thing that plays out in branches across the country every week. Imagine a 78-year-old widow who gets a phone call from someone claiming to be with a well known tech company, telling her that her computer has been hacked and that scammers are about to drain her bank account unless she moves her money immediately into a protected account they'll help her set up. She's frightened, she's alone, and the person on the phone sounds calm, official, and reassuring, which is exactly the design of this kind of scam. She goes to her bank to wire several $1,000s to an account she's never used before. A teller who's been trained on these patterns notices that this customer, who normally only does small transactions, is suddenly asking to wire a large sum to an unfamiliar account and seems anxious, repeating phrases that sound like they're coming from someone else rather than from her own understanding of the situation. That combination, unfamiliar recipient, urgency, fear, and a story that doesn't quite hold together when gently questioned, is precisely the pattern these hold laws were built around. The teller loops in a manager, the transaction gets held under the bank's exploitation policy, and the woman, even though she's frustrated and confused in the moment, ends up with her money still in her account the next morning instead of in the hands of a scammer halfway across the world. That's the system working as intended, even though it doesn't feel pleasant for the person standing at the counter wondering why the bank suddenly won't do what she's asking. Of course, the same system can occasionally catch something completely legitimate, and that's the trade-off worth understanding honestly. Maybe that same woman really was sending money to a grandson for a real emergency, and the whole delayed something urgent and well-intentioned. That's the uncomfortable side of these laws. They're built on pattern recognition, not certainty, which means they will sometimes slow down a transaction that turns out to be completely fine. The protection against that frustration isn't avoiding the rule, since the rule exists because the alternative, no oversight at all, has cost American seniors billions of dollars in losses, according to federal reporting on elder fraud. The real protection is making sure your bank has accurate, up to date information about you, a trusted contact on file, and if you know in advance that you're planning an unusual transaction, like a large gift to a family member or a one time payment for something out of the ordinary, giving your bank a heads up beforehand so it doesn't read as a surprise. Let's talk about a common mistake people make here because I see this trip families up constantly. A lot of people assume that once they've given someone power of attorney, that person can do absolutely anything with their account with zero oversight, no questions asked, ever. That's not entirely true, and it's actually one of the exact situations these hold laws are designed to catch when something looks wrong. Banks are trained to watch for sudden or unusual activity, even from someone holding a valid power of attorney, especially if the pattern of transactions changes dramatically right after that authority is granted. This doesn't mean power of attorney is a bad idea. For most families, it's an essential and responsible piece of planning, but it does mean you shouldn't assume that paperwork alone makes an account completely invisible to scrutiny. If you're setting up power of attorney for yourself or helping a parent do the same, it's worth having an honest conversation with the bank about how that authority will be used day to day. So there's a paper trail of expectations on file rather than a surprise later. While we're on the subject of who gets pulled into this process, I want to address something that worries a lot of people I hear from, which is the fear of adult protective services getting involved at all, almost like it's a punishment. A PS involvement here isn't about taking away your independence or your ability to manage your own life. Their role, when a bank reports a concern, is typically to do a welfare check, ask some questions, and assess whether something concerning is actually happening, whether that's a scam, exploitation by a family member or caregiver, or simply a case of cognitive decline that's making it harder for someone to manage money safely on their own. In the vast majority of cases where the activity turns out to be completely legitimate, the file gets closed and that's the end of it. It's not a strike against you, and it doesn't get attached to your credit or your banking history in some permanent way. It's simply a built in check that exists because, frankly, the financial industry has watched too many older adults lose everything to scams that moved fast and went unquestioned. If you've made it this far, drop a comment below and let me know which state you're watching from, because I genuinely want to know how different this looks depending on where you live, and it helps me figure out which states to dig into more specifically in future videos. I also want to take a moment here to genuinely thank you for sticking with me through this one, because I know this topic is dense. It's not the flashiest subject in the world, but it's exactly the kind of thing that protects real money for real families. When it actually gets explained clearly instead of buried in legal language nobody has time to read. If that's useful to you, subscribing helps a lot. It tells me there are people who actually want this kind of plain English breakdown, and it means you won't miss it the next time I cover something that could affect your accounts, your benefits, or your taxes. Let's get back into it because there's one more layer to this that doesn't get talked about enough, and that's how this rule interacts with joint accounts and with adult children who are added onto a parent's account for convenience. A lot of families add a son or daughter to a checking account so they can help pay bills or handle things if mom or dad gets sick. That's a completely reasonable thing to do, but it does change how these protections apply because now there are two account holders, and unusual activity from either one could potentially trigger the same kind of review. If you're an adult child in this position, it's worth being transparent with the bank about your role on the account, sometimes even putting a short note in the file explaining the arrangement, so that if you ever do need to make a larger transaction on your parents' behalf, like paying for a major medical bill or a move into assisted living, it doesn't accidentally read as a red flag to a system that's specifically built to catch sudden, unexplained, large transfers out of an older person's account. Another thing worth knowing is that these hold rules generally apply to disbursements, meaning money leaving the account, not to the account being frozen entirely in the sense of you losing access to see your balance or use your debit card for everyday purchases. In most cases, what gets held is the specific suspicious transaction or transfer, while normal account access for things like grocery shopping or paying a regular utility bill continues as usual. This is an important distinction because the scary version of this headline that circulates online sometimes makes it sound like your entire financial life could grind to a halt overnight with no warning, and that's generally not accurate. The hold is meant to be targeted and temporary, focused on the transaction that triggered the concern, not a blanket freeze on your whole financial existence. It's also worth clearing up a couple of other misconceptions that tend to circulate alongside this topic. This isn't a rule that only applies to big national banks. Smaller community banks and credit unions are generally held to the same standards, sometimes through their own state regulator rather than a federal one. But the underlying obligation to watch for and report suspected exploitation applies broadly across the industry. It also isn't something that only kicks in once, like a one-time check at age 65 that follows you forever after. It's an ongoing pattern recognition system that runs continuously, checking each unusual transaction against your typical behavior, which means a perfectly normal account can go years without ever triggering a hold. And that's actually the most common outcome by far. And finally, this isn't a punishment tied to your credit score or your ability to open new accounts in the future. A hold that gets resolved because a transaction turned out to be legitimate doesn't follow you around or show up as a mark against you anywhere. It's simply a temporary pause that gets closed out once things are verified. Now, I do want to be honest with you about something because I think it matters more than giving you a tidy, reassuring ending. I can't tell you exactly how this rule will play out if it ever happens in your specific situation because it genuinely depends on your state's law, your bank's internal policy, the nature of the transaction that triggered the review, and how quickly you're able to respond and verify what's going on. Some states have stronger, faster acting laws than others. Some banks are more proactive about catching this early, others are still catching up. I'd rather tell you that honestly than promise you a clean, universal number of days or a guaranteed outcome. Because anyone telling you this works exactly the same way in every state, for every bank, for every person, isn't giving you the full picture. So let's recap everything we've covered because there's a lot here. Banks really can place a temporary hold on transactions for customers who are 65 or older or who qualify as a vulnerable adult under their state's definition when staff reasonably suspect financial exploitation. This authority comes from a combination of the Federal Senior Safe Act, which protects bank employees who report suspected exploitation, FINRA Rule 2165 for brokerage and investment accounts, and individual state laws that set the specific rules, timelines, and age thresholds for these holds. The triggers usually involve a noticeable, unusual change in financial behavior, large or repeated withdrawals, unfamiliar wire transfers, gift card purchases, or new people suddenly involved in someone's financial decisions. If a hold happens, you're generally entitled to notification, an explanation, and a path to get it resolved by verifying the transaction was legitimate. And setting up a trusted contact ahead of time is one of the simplest ways to make that process smoother if it ever comes up. Power of attorney doesn't make an account immune to this scrutiny. Joint account holders should be transparent about their role to avoid confusion. And Adult Protective Services involvement, when it happens, is meant to be a welfare check, not a punishment. If this helped clear things up, do me a favor and send it to someone over 65 in your life, a parent, an aunt, an older neighbor, because most people have genuinely no idea this system exists until they're confused and a little panicked about why a transaction didn't go through. Drop a comment too and tell me if this has ever happened to you or someone in your family, because those real stories are honestly what help me decide what to dig into next on this channel, and I read every single one. I'm Margaret Wells, and next time I want to walk you through exactly how to set up a trusted contact step by step with the specific questions to ask your bank, because almost nobody does this until after something has already gone wrong, and I'd rather you have it in place before you ever need it. Thanks for watching this far, and I'll see you in the next one.